So this video is on consolidated cash flow statements. Yeah, so we can get straight into the question. Fimba PLC is public listed company that has subsidiaries and associates. Fimba prepares its accounts 30th September each year. So during the year ended 30th September 2022, Fimba purchased 80% of the issued equity share capital of Upoke PLC for 500 million kwacha, payable in cash. The net assets of Upoke at the date of acquisition were assessed as having fair values as follows. So this statement we're just seeing below is the net assets of this subsidiary that was acquired. So I'm now interested in the adjustments so that they help us build to now solving this cash flow question. Yeah, so the first part is saying from time to time the group invests cash surpluses in listed securities, which are shown as current asset investments in the consolidated statement of financial position. So right in our financial position, there's something they've mentioned as investments. I hope you can see that it's under the current assets section. Yeah, so that's what they were talking about. It's just a statement, and what we'll do with that investment is that it will be part of what we'll compute as our cash and cash equivalents. I'll explain further as we go through the question. The second one is a depreciation of tangible current assets for the year total 290. So that's telling you this is a charge for the year. That one which we add back in our cash flow statement. Then intangible assets comprise of goodwill. Okay, so meaning we'll need to also have a working where we test for impairment, because once goodwill is in the question, we always want to test for goodwill just to be sure that there is no impairment taking place. Then the fourth one is trade payables at 30th September 2022 and 30th September 2021 do not include any accrued interest. So they're just trying to emphasize that there is no accrued interest that is seated under the payables figure. Such a statement as well that we have to take note of. So the fifth one is there were no disposal of non-current assets. So that's what we have for today's consolidated cash flow. Let's just go through what we need to prepare, and these adjustments will all play a role. I'll be explaining as we go by in this video. So to start off with our workings, let's start with goodwill first. Why I'm saying goodwill is I want to first begin with the impairment test procedure first. So to test for goodwill, what we need to do is we also need to account for this goodwill that is acquired when we get a subsidiary. So that's why we need to start with the goodwill calculation. So as per rules of consolidation, when you're calculating goodwill of a subsidiary, we need the purchase consideration, and we were told from the onset that it was 500 million kwacha in cash, payable in cash. They even mentioned that. So that's the purchase consideration. Then what about the net assets? Because when you're calculating goodwill for a subsidiary, you need to come and now subtract the net assets at acquisition. So we were just given a short statement there of the net assets of this subsidiary called Upoke PLC. That was 525. So you're basically just going to say, okay, 525 are the net assets, but you're not getting everything. You're just getting the percentage of what? Control, which is 80, which was mentioned in the intro of the question. So that's going to give you 420. There you close. What else are we getting? When we, in fact, we're supposed to subtract this. This is giving us 8. So this is the goodwill on acquisition. After that, what next? We go and now test for impairment in this tier account we're making, and then we will need to have the opening balance of goodwill. So let's just quickly check that in the question paper. So when you look at the question paper there, you will notice something like intangible assets under the non-current assets section. You will notice that in 2021 it was 95, and then in the other year it was 170. So let's do that, and we'll switch to that. And what I can also just advise is you can take a moment and maybe just screenshot this part, and also the other last part of this bank balance sheet as well. The reason being is so that you can have the question, because from now on, I'll just be going forward with solving the workings, and then from there on produce the consolidated cash flow. So I'd advise that you first pause video, screenshot the question, maybe add it on another screen as you're following through with the video. So back to this table, this T account, sorry. Our opening balance was 95. Remember, this is an asset, so you debit the opening balance. Closing, we'll put it here, 170. Then, what about the 80? Where does it go? That one we're calculating later on. So this 80 is supposed to be added. Why? It's increasing goodwill. That's the whole point where we're even debiting it more, because it's increasing the asset. So now from there on, we need to solve for the difference, and you find that it gives you 5 kwacha here, and that will be what? Your impairment. So this will come back for it as impairment. When we start consolidating, just take note. Next working we can do here is assets. We can find any purchase, a possible purchase of a non-current asset. Reason, like we said, of course there were no disposals. They mentioned it in note number 5. But when you've been given non-current assets, it's always advisable to test whether they purchased or not. Why? Even the figure for non-current assets gets to show you something. You find that it's increasing. So that's a hint that most likely they've added in an asset. So let's make the asset account to test whether they purchased or not. The opening balance is 14. So like I said, if you've captured the screenshot of the question by now, you'll be able to follow what I'm now doing. And then the other one, the closing balance was 1450. Yeah. Then furthermore, we want to add some few things in this account. In this account, what happens is that these figures we have put from the non-current assets totals that we're getting, okay, from the non-current assets totals that we're getting from the balance sheet, these are carrying amounts. Why do we say that? Because when you're placing anything in the statement of financial position, they're supposed to be stated that they are carrying amounts, meaning less they have already been netted off from depreciation. So now when you're trying to find the purchase of an asset, we somehow reverse the process, since these have removed depreciation. So now we want to get back to costs, like how much the costs of the assets were at. So what you do is you add back depreciation first, which is this side. We are adding it to the closing balance because that is the one which has been netted off from the depreciation. So for it to even be closing in this final year we're preparing the cash flow for, then that shows us that depreciation has already been netted off. So it's like you just reverse the process, because you're trying to take everything back to cost, because in an asset account everything is stated at cost price. That's the hint there. Basically, that's what we're doing. If these are carrying amounts, that's what you do. So then after doing that, the next thing is check that on acquisition, when you bought this subsidiary came in with some tangible non-current assets as well. They stated something like 300 in the intro of the question. Add that's extra assets. So whatever you have plus whatever you acquire from a subsidiary also is included in yours. This is why this is consolidation, because you're adding on whatever a subsidiary has, what you have, you combine. Next, what else do we have? Nothing more to add. We don't have revaluation in the question. If it was there, I would have put it. We don't have disposals. If we sold an asset, we should have credited this account. So all those should be taken out. So this is what we have according to this question. So for the difference, and it will give you about 40. This one will call it acquisition of non-current assets. That's what we'll call it under investing activities in the cash flow. Next tier account that we really need to do now is dividends that we could receive from NCI. Why are we also calculating this one? When you just see non-controlling interest in your statement of financial position, make sure you do these tests of the dividend that has been paid out. So again, like I said, if you've taken the screenshot, we'll just go straight into the figures. The opening balance in 2021 was 225. So this account you credit it. Why? This is all equity accounts have got credit balances. So 225, and then we have to add that profit that is attributed to NCI. You'll find it in the profit and loss statement. You'll find it somewhere there, somewhere at the bottom. So you'll see something like attributed to And let me just show you this one. So that's what I'm now talking about, attributed to non-controlling interest. So we need that 50. Why am I not picking this other 30 that's on the other side in 2021? Well, when you're dealing with the profit and loss, you only focus on the current year. A profit and loss statement is periodical. It's not, comparative like the way the statement of financial position is. So hence we'll just go for the 50. And the requirement is when you're calculating dividend, make sure you add that profit that is attributed to the NCI. So you put in your 50 there. The next one is if you have acquired a subsidiary, like what just happened in this question, we acquired a subsidiary and the net assets were also provided. So it's very easy. What we need to also do here is we need to get a portion of the net assets that should also be attributed to NCI. And if the net assets were 525, knowing the group structure of 80% is what we control, meaning the other 20 goes to NCI. So 20% of 525 gives you what? 105. Okay, then that's that. You've done, sorry, let me not even box this one because this is not the key figure. The key figure will come soon. Okay, yeah, so 105. Then the next thing that we put in, what's the closing balance? The closing balance according to the statement of financial position was 355. Now let's solve for the difference here. The difference will pop up on the debit, which will be 25 kwacha. So that will be now the dividends that we pay off to NCI. That's how you find it, just using this T account. We can also go further and also find the dividend that is paid to the parent, because also the parent does have payouts of dividends as well. So also put for the parent. Some questions will give you these figures, some, not always, yeah, but you need to know how to find them if not given. So for the parent, use retained earnings. The retained earnings that is stated in the balance sheet. So you find that in the balance sheet there, we have opening balance was 835. Also this one, just like we said, add attributed profits to NCI, this one to be add the profit that is attributed to the parent. There was a 460 there, so 460, that's the one you get. And then the other one is closing balance was 1165, that's the one you put. Then so for the difference again, you will get 130. This is the dividend paid out to the parent. So both of them will come and show in the cash flow when we reach there. Next important working, investment in associates. Investment in associates. So this one, why are we also calculating this one? We saw something like investment in associate. Let me just show you as well. So like we have zoomed in just below intangible assets, you see investments in associates. So that's a hint that if you have an associate in the company, then you are receiving dividends from them. Usually that's how it is, because an associate is like an investment and you will be receiving some dividends from there. So we get the same thing. We'll get the comparative figures from the balance sheet, the 350 that we're seeing and the 400. We need those figures. So let's make the T account. So we get into it. We said 350 opening, and this is an asset, so we debit that opening. Closing 400. The next one is anything that we add in this account. Do we also add anything like a profit like the way we added in the previous one? Yes, we do. This time we're getting the share in associate profits. There's this one is found in the profit and loss. It's here. Let me show you. So it's stated right below finance costs. You'll see it as share of profits of associates. That's the one you get. Is you have to add it on the debit side of this account we're making. So it's about 85 kwacha. That's the one we're getting. So we get our 85 and add it there. Sorry for that. Okay, so 85. And then from there, we just hope for the difference. Again, you find that we're getting a difference of 35 on the credit here. So this is dividend received from associate. So you even say dividend received. So this one is an investing activity item, because any dividends that you're receiving is usually actually falls under investing activities. Another key one that we need to prepare, I think the last one for this question is tax, the tax T account. So for tax tier account, you have your opening balance according to the balance sheet, which is supposed to be 40. Closing 50 was stated in 2022. Then what things do you add first? Add the tax that is coming through acquisition of this subsidiary. So I'm sure you've been hearing add from what's been coming from the subsidiary. It was mentioned on the earlier page we started with. Let me just show you so that at least we're moving together. So these are the figures I've been talking about. The non-current tangible total, that one we got the 300, I'm sure you're now seeing it. The taxation I've just talked about, we also need to get it. Because when you acquire a subsidiary, the rules of consolidation, according to IFRS 10, say that we have to combine assets, liabilities, so everything has to be added to whatever you have as a parent. So we're going to get that 25 and also add it in this T account. So 25 we've added. Another one we need to put in this account is what taxation was charged for the year. So according to the profit and loss, there was 175. So this one is also credited, by the way. So now you solve for the difference, you find that it's giving you 190. 190 is the figure. So this figure is what we'll call tax paid when we are dealing with our operating activities. That last part of the operating activities, when we say less tax paid, this is the 190 we're going to use. Yeah. Then another crucial thing before we forget, whenever you acquire a subsidiary, you need to know the cash that you're going to pay. This is outflow. Remember, this is a cash flow statement. We're only interested in things that were transacted using cash. So the fact that you acquired the subsidiary and they even said it was payable in cash, we cannot ignore that money. We have to include it in the cash flow statement. So they said they're supposed to pay what? 500. Under normal circumstances, I'm just supposed to come and show it in the cash flow as what? 500. But there's a catch. Remember, like we said, those net assets that the subsidiary comes with, it comes in with also some cash as well. It came in with a cash value of about 50. So the fact that it comes in with cash, what happens is you're supposed to pay 500, quite right. But the fact that this new subsidiary comes in with some money of some sort, so it sort of nets off. So that's what they say. You're supposed to get the net cash paid. So instead of 500, you're going to just record 450. That will be called spent on the acquisition of sub. So that will be the detail you would write specifically to be under investing activities. This total 450. The next thing that we'll deal with are the working capital adjustments. Then we're done. So working capital, there are a lot of there are three things mainly there. So you need the opening balance. Opening balance is for inventory. It was 450 in the balance sheet. Trade receivables, the opening balance was 500. Trade payables, the opening balance was 250. Add additions as well. Why? Remember, like we said, this subsidiary is coming in with some net assets. And on those net assets, inventory is there, trade receivables are there, trade payables are also there. So, like we said, we have to add. That's the whole rule. Those are the rules of consolidation. So, for the additions, can you just say plus this one adds on 150 extra from the acquisition of the subs net assets. That one adds on 125, and this one adds on 75. Then closing. Now, what we close with? The closing balance is according to the balance sheet where 525 for inventory, 600 for trade receivables, and 325 for trade payables. Now let's get the movement. The movement is what's key, because remember, when it comes to cash flow, we're just interested in the movement. Was it an outflow? Was it an inflow? That's the main language that the cash flow speaks. So this is what we're interested in. That's why we want to find the movement. So what we'll do is once we add this, the key is add the additions to the opening balances and then compare to the closing. Then you tell, has it gone up or has it gone down? So if you notice in the first scenario, when I add on to the opening balance, I'm actually getting a higher figure than the closing, meaning it has decreased by how much? By 75. And the decrease in inventory means what to your cash? That is inflow. Why? Inventory has dropped, meaning people are now buying. You're selling off. That's why your stock is reducing. That's the understanding there. The next one is trade receivable. Trade receivable, if you add on your 500 plus the 125, it's also higher than the closing figure for the trade receivable, meaning they also dropped. What is the interpretation for that? If trade receivables are going down, then your debtors are now paying. The balance of the people owing you are now reducing. So people are bringing in cash. So that's an inflow. So you do that. You keep it positive. In short, that's why I've kept them positive. Then you've got your 75 and your 25, which have to be shown in the cash flow when you reach there. Yeah, so like I said, this is the final working. We can now go straight into the consolidation part of the cash flow. Yeah, so now before that, there's always a proof test. You can do it now, you can do it at the end, but I can show you now. So to prove that you will balance your cash flow once you're done preparing it, first identify all the cash and cash equivalents, all of them in the question. And cash equivalents include bank overdraft, treasury bills, but they're not there, cash itself, bank as well, and investments. There was something they showed investments, but careful. The investments that they show under current assets, like in this paper or this question paper, that is short term. If it's shown under current, it means short term. If it's shown under non-current, it means long term. So long term is not a cash and cash equivalent. Remember, cash and cash equivalents are basically items that can be quickly converted into cash over a short period of time. Very short period of time. And for something to be categorized as low as non-current, then of course that is not a short period of time. That's why we're saying anything current qualifies here, but not everything, of course, but these specific items, yeah, that I've mentioned: treasury bills, bank overdraft, cash itself, bank, and these short-term investments. So the opening balances were as follows. Bank overdraft had 400 as the opening, but bank overdraft is not positive cash. Let's understand that this is negative cash. Why? You've overdrawn already your account, it cannot remain positive. That's why I'm saying any figure in the bank overdraft statement should be put as negative. The cash itself is 25. The investments are 350. Opening. Closing balances were as follows: 100 for bank overdraft, 50 for cash, and 100 for investments. Now, like we said, we are interested in the movement. The movement is just basically you're just getting differences here. So for the bank overdraft, there's a movement of 300. Now, is this inflow? Is this supposed to be a positive or a negative movement? This is the one which confuses many people, but let's get it clearly. Remember, this is negative cash. You are at negative 400 and you're now at negative 100. What has happened? Is it a positive effect or a negative effect? This is a positive effect. Why? Because like someone has brought in a 300. That's why we'll keep it positive. And that's the only way the negative number is now slowly reducing, heading towards a positive, because you've added in a positive figure. You can just use your normal language knowledge of mathematics. Then for cash itself here, 25 to 50, that's an increase of 25. That remains positive as well. Investments, there's a drop from 350 to 100. That's a drop by 250. This should not remain positive. This should be in brackets as a negative. Why? It has reduced. That's the understanding here. Then therefore get total movement 75 positive. And this is your balancing figure. Now let us prepare the consolidated cash flow statement. So now in summary, this is the consolidated cash flow statement. We have started with adding back. Always start with your net profit before tax. That's the rule, and it's 685. So you put it there in the far corner, second column. You have the next one, your depreciation, it's 290. You also put that. Investment income. There was something like investment income in the profit and loss statement. Why am I removing it here? The reason is that investment income is not an operating activity item, so hence you need to remove it first, because it was part of that profit which the operating activities start with. So hence we need to remove it first and then come and place it in the right place, which is the investing activity section. Hence that's why we did that. Impairment loss has to be added back. Why are we adding back these? These are non-cash items. Initially, they were being subtracted as expenses. But now, since they're non-cash items, we're trying to reverse the whole process so that we can only recognize cash items. So adding back. That's the whole point of doing all this. Share of associate profit. Same thing. We need to add back. Sorry, we need to subtract this share of associate profit as well. It's like double counting, because some part of our investment is gotten from the profit as well. Finance costs as well has to be first added back. The reason is that as long as you're starting with your profits before tax, you need to add back finance costs because you're trying to head back to what we call operating profit. And the only way you can reach operating profit is by adding back finance costs as well. Yeah, then after that, you get your 430. That's a summation of those things. Then you add it to your profit before tax. You're getting your 11115 there, 1115. And then now you go to your working capital. Working capital, those things we calculated, the movements in the inventories, trade receivables, yeah, those are the ones now. Trade payables had no movement, by the way. It was zero because it added up to the opening was equal to the closing, so that's why it's not even appearing here. And remember, these were decrease. You have to state them just like this. Don't just say inventory. Decrease in inventory like that. Then you state them, and if they were positive, keep them positive like they were in this question. And we added them. Push the total that side. Keep on accumulating the balance in the second column, less the following things. Like you can see, tax paid, the one we found, the same figures are now coming back. Finance cost comes back again. The reason again it's coming back, we are now supposed to remove it in the right way. So initially we were just trying to get to operating profit. That's the first step. That's why we first add it back. Then now once you've adjusted, then now you can come and rightfully remove this finance cost at the end again. So it's like one thing you can notice about starting with profit before tax is that finance costs or interest is treated twice. Yeah, so dividends to the parent and NCI, this is how you put them here. You can put them here in the operating activities. And by the way, all these were supposed to be what? Subtracted. All those. That's why we said less the following, like that. The final total there is thrown, subtracted. Yeah, now in your investing activities, you start with the purchase of the non-current asset, the 40 that we found, the 450 as well from the acquisition of the subsidiary, the one we found as well. Investment income rightfully placed now in the correct section. Dividend received, that 35 we found also for investment in associates. That's the one which we added. It's inflow, it's money coming in. Then of course you total the stuff. It was negative 425 from this section. We move on to financing activities. Financing activities just had two things. There was only debentures and loans. Even share capital can be here. The only thing is that both the opening and closing balance on share capital were equal. So there was no movement in that. So we left that out. Only the following loans had something like opening of 450, closing with 0. So the movement was 450. And if loans are reducing there, that's negative cash. Why? You are paying out. So if your loan balance is reducing, then you're paying your loans. It's you paying, and meaning you're losing cash. That's why it's in brackets. So debenture as well had an opening there of about should be about 470, closed with 800. So that was an increase. It's like your debentures were increasing, so no money has gone out yet. So hence it remains positives. That's a 330 you're looking at. And basically we sum up and end up with what? 75. That balancing figure we found earlier on. So this is how you first prove it. Then so that when you prepare your cash flow, you're able to see that, okay, I've now balanced. Then of course wrap up your cash flow in the following manner. Cash and cash equivalents at the beginning. What you're just doing with this statement is you're just summing up the opening balances of all your cash and cash equivalents. Those three that we listed earlier on, when you sum them up, they're giving a total of negative 25. That's what they mean by cash and cash equivalents at the beginning. When they say cash and cash equivalents at the end, they are just referring now to those closing balances of those cash and cash equivalents. So when you sum them up, they are giving 50, and it has to add up, and then the cash flow also balances. And that's it for consolidation of cash flows.